Happy Monday. Stoked to be here. Great weekend. Got to spend some time with my mom uh, as she was in town to visit and see our newborn and spend some time at the pool with my girls. It was good. Hot though, super hot this August here in Southern California. But yeah, really, title today is the job market just changed the mortgage story. So essentially, let's think about bad job report or not so great job report. It's better interest rates. So we finally got the kind of economic report that I've been waiting for. Friday's jobs report was much weaker than expected, and bonds rallied afterwards. We saw that throughout yesterday or Friday afternoon, pardon. And of course, we saw a modest improvement with interest rates. But it is important, we're not out of the woods yet because we have consumer price index, we have PPI, retail sales, treasury auctions, and continued geopolitical oil risk this week. But here's my take. For months, I've been saying the bond market needs evidence that the economy is slowing. Well, we're finally starting to get some. Right? That's what we saw with those reports. So let's go to the labor market. The latest jobs data came in materially weaker than expected. And that matters because employment is one of the Fed's two mandates. Remember that, right? They're going to look at that. They're going to see slower hiring, less wage pressure, potentially less inflation, potentially room for rates to improve thereafter. So mortgage bonds reacted positively Friday. And then, of course, we know that mortgage applications are declined because of higher borrowing costs. But now we're seeing some applications coming through the weekend already. I'm looking at what we have on our docket for today. And there's quite a few applications of folks that had gone out to view homes even in this heat and want to get pre-approved. So remember this, bad economic news can actually be good for mortgage rate news. It's not inflation. Bad inflation, of course, pushes treasuries higher. But you look at the jobs market, you look at GDP, you look at things that can slow growth. They're going to cause yields on treasuries to come down a little bit. Because of that, usually bad news in the markets, as I've said for years, means better news for interest rates with mortgages. So I know I don't want unemployment. I don't want people losing their jobs. But this is how the bond market interprets economic weakness. And that's a very, very important distinction. Now, the consumer price index, CPI, becomes huge. This is a big, big thing to be watching this week. So jobs told the market of the economy may be slowing. Now inflation has to confirm it. Wednesday is when we're going to get what we call a monster report, right, for this week in August, because later in the month we have the Jackson Hole meeting with the Fed. So keep in mind, CPI Wednesday, we have PPI, which is producer price index, that comes on Thursday, and retail sales come in on Friday. So that said, we also have treasury auctions that can move yields. And why I say this, not to get too technical if you're unfamiliar with how interest rates move, treasuries, especially the 10-year, usually has been cited and known to have some sort of close relation, even though not directly connected, to mortgage bonds. Why? Because mortgage rates are based off of a mortgage bond. It's called an MBS, a mortgage-backed security, right? So as we look at these things, keep in mind, going back to that jobs number from last week, jobs just opened the door for lower rates. Now, CPI, Consumer Price Index, which is the inflation report, decides whether we get to walk through it. If CPI comes in cool, bonds could build on Friday's improvement. If it comes in hot, we could give a lot of it right back. So let's not forget, Iran and oil still matter. So energy and geopolitical risk remain wild cards. Oil feeds directly into inflation expectations. We saw that in the last 5 months now, right? Since March, early March. Even if the U.S. economy slows, another energy shock can complicate the bond market story. So it's basically tug of war. It's the tug of war you've been watching all year. Slowing economy on one side, inflation and oil on the other. Something else has been happening in mortgages, and something we should be looking at is looking at non-QM, HELOC, and DSCR products. I've had several financial advisors, CPAs, approach me within the last 5 days saying, hey, consumer spending out. Some of my clients, folks that, they manage or oversee funds for, or look at the books for, whatever it may be, right? If you're CPA, you're obviously helping often with bookkeeping, accounting for, individuals that are your clients, financial advisors, very similar. So we're seeing people not want to change their first mortgage, especially if they have a 2.5% on their 30-year fixed. So we're seeing HELOCs, so second mortgage, a line of credit, become increasingly more popular to help improve the cash flow and liquidity through cash flow. For a lot of these clients, we're seeing home equity loans. For self-employed individuals, we're seeing a lot of people using bank statement loans, asset depletion, right? We're still seeing a lot of people still purchasing using creative financing. We're seeing seller credits in the market, huge. If you see a property sitting for 30 days or more, chances are the seller will work with you. And we're seeing investors come back in. Now we have 5 DSCR purchases, which uses the income of the property to qualify it. They're incredibly popular in this market. So the biggest mistake I see is someone getting told no by one lender and assuming that they can't buy. There is a lot of opportunities for a lot of folks. Don't let your bank or credit union turn down mean that there may not be a product that's convenient, easy to work through, an easy workaround, and actually priced competitively or close to what that conventional mortgage may have priced. Now, the weird part about this housing market, let's talk about this. We saw a couple of posts come out. Russell Brand posted something about saying it's going to be like 2008 and we're hedged for it. Well, appreciate Russell Brand. That Greek movie is in with Jonah Hill was funny years ago. But let's be honest. Very honest. We've been talking about a market crash in housing since 2016. It's 2026. Interesting how folks like to talk about it, time in and time out, and they're kind of kicking the same rock around the parking lot, and it's not going anywhere. Why? Some markets are getting improvements, 100%. If you bought a bunch of investment properties and you have tenancy issues or whatnot, I understand the strain there. That could mean that you're going to sell the property less. But keep in mind, we have more people with 50% more equity in their homes than we've seen throughout history. Keep that in mind. If you have a property that you bought for $500K, it super appreciated in the last 5 years to $1 million. And now it comes down in price to maybe $900,000. It's 10%. It's $100,000. So that's a big number. So you're going to headline on, right? Well, if you can't sell for $1 million, you could sell for $900,000, perhaps $800,000. The point is they still bought it for $500K. They're not foreclosing if they're not upside down. They're going to sell for less. We still have supply and demand issues. We have demand for housing with a limited supply and affordability issues at that. What does that mean? People are going to buy houses if they can, where they can. And we're still seeing multiple offers in every property. Headline articles are great clickbait, but facts are facts. Remember, you're entitled to your own opinions, but you're not entitled to your own facts, right? So it's an interesting environment. Less buyer competition in some markets, more buyer competition in others. We're seeing more seller negotiation. We're seeing credits, price reductions, creative financing, less fear of missing out. Buyers get to decide on the property they want rather than scramble to try to buy anything. They're not as frantic. Now, that gives them more time to actually analyze a property. So lower rates could help affordability, but if rates drop enough, brings everybody off the sidelines, guess what happens? You may get your lower rate, but you get rid of your negotiating leverage, and next thing you know, you're competing with 15 to 20 people in the same property all over again. So here's a take. My opinion, stop waiting for a magic mortgage rate. People say, I'm going to wait for 2.5%, 3%. It's probably not going to happen in a lifetime. Wait for rates to go back to 5%. Okay, what if they don't? What if they at 5.75 and everybody comes up at once? A $900,000 house has 20, 30 offers and it goes for $1,050,000. You just spent $150,000 more on that same property. I'm not telling you to buy regardless. I'm saying run the numbers today. If they don't work, don't buy. If they do work and it seems to work your budget, your lifestyle, and really could continue to help you live your life so you're not house rich, cash poor, you're not living on top ramen and ready packs of salad, it may be time to purchase a property. All right. Bring it all back and back to what I was talking about. Friday's jobs report was good news for mortgage rates. Now we need inflation to cooperate. CPI is a big one I'm watching this week. If inflation confirms what employment is starting to tell us, we should finally have some interesting happenings in the bond market. But I'm not betting somebody's home purchase on a prediction. And we should build strategy about what works today. And if rates give us the opportunity later, we'll take advantage of it. Feel free to share this with anybody you know. If there's any questions you have, my links are below. I'm here, happy to help. Have a blessed week.